A client recently asked me something interesting. They said, our family is growing and we want to upgrade our home, but most of our income, a lot of our income is coming from restricted stock units and stock options. So the question became, can stock compensation responsibly support a home upgrade? And a lot of people working, especially in tech, eventually run into this exact situation. Their salary is strong, but a meaningful portion of their compensation comes from RSUs, ISOs, or other stock options, and then life suddenly changes. Maybe you're starting a family. Maybe your family is growing. Maybe the home that once felt big suddenly starts to feel very small. And the question becomes, can we use our stock compensation to upgrade our home? But here's one problem most people don't think about. What if the stock price drops? And for those of you who don't know me, my name is Josh. I run an independent firm called 369 Financial. We focus on building financial strategies for our clients rather than selling any financial products. This allows us to focus on planning first and investments as well. And we recently worked through this exact situation with a client who lives in the great state of California. Their situation is actually very common. I've seen it a bunch of times. They owned a smaller home, their family's growing, and like many professionals, especially in tech, a meaningful portion of their compensation, which is also taxed, comes from equity compensation, RSUs, stock grants, company stock. So they asked me this simple question: can we use some of our stock compensation to upgrade our home? At a first glance, the numbers looked fine, but whenever stock compensation is involved, the real question becomes something else. Does the plan still work if the stock price falls? Because if the entire plan depends on the stock price staying high, that's not really financial planning. That's speculation. This situation comes up all the time for those that work in tech. Your total compensation might include base salary, bonus, RSUs, sometimes stock options. And on paper, the total compensation can look very strong. But a part of that income is tied to market volatility, and markets don't move in a straight line. So instead of assuming everything goes perfectly, we ran a stress test, and we looked at two different scenarios. The first scenario assumed the stock price stayed relatively stable. The second scenario assumed that if the stock price were to drop by about 40%, and that might sound dramatic, but technology stocks have experienced moves like that many times before. Stress testing simply helps us answer that one question: is the plan resilient? In the first scenario, we assume stock compensation continued performing well. And under those conditions, using a small portion of RSU income, or actually in this case that we were doing a large portion of the RSU income to support the home upgrade, it looked manageable. The housing payment stayed within a reasonable range relative to the overall income. Then we ran the more conservative scenario. In this version, we assumed the stock price declined significantly. That reduced the value of the RSU income supporting the plan. And suddenly, the financial picture looked much different. It wasn't going to be impossible for this to happen, but it definitely made things tighter. Now, the purpose of this exercise isn't to predict the future. No one can predict the future. If they ask, I have my magic 8-ball. And no one can consistently predict where a stock will trade within the next 6, 12, 18 months. So stress testing simply helps us understand how sensitive a decision is to change. And when you take a long-term commitment, like a mortgage, 15, 20, or even 30 years, you want a plan to help survive during the good times and the bad times. There are actually several ways people use stock compensation when upgrading their homes. Some people decide to sell the vested restricted stock units to increase their down payment. Others sell a portion of the RSU each year to help supplement their income. And other people treat their RSU simply as part of their long-term investment portfolio. Each approach has trade-offs depending on someone's goals, income, stability, and how much risk they're willing to take on. And another topic that often comes up with equity compensation is concentration risk. And a lot of financial advisors will attempt to talk to you about if a large portion of your wealth is tied to a single stock company and how that can introduce additional volatility. So a lot of financial advisors may tell you to, reduce that, but it all depends on the company. Is that company actually diversified? as they have a large moat, and some investors gradually do sell shares over time to diversify. However, in more advanced situations, some people explore option strategies that can help manage downside exposure, and these approaches can be complex and they aren't appropriate for everyone, but they sometimes are part of a broader conversation when managing equity compensation, especially if your company that you work for is really good and you like them for the long term and you're looking to protect your downside in terms of using certain strategies. So when evaluating a decision like upgrading a home, we often simplify things into 3 categories: green light, yellow light, and red light. Green light, self-explanatory, means the plan still works even if stock prices fall. Yellow light means the plan works today but becomes a lot tighter if the stock price drops. And red light, this is probably self-explanatory. It means the plan only works if the stock price stays high. And when something falls into that red category, that's usually a signal to slow down and rethink the structure of what you're looking to do. And upgrading your home is rarely just a financial decision. Sometimes it's more about your family, more space, better schools, or you're at a different stage of life and you're looking to change things up. What we need to be aware of is when equity compensation is involved, the goal is to make sure your decision works regardless of what the markets are doing to the best of our abilities. That's because a strong financial plan is built around being resilience, not optimism. And just as a quick reminder, this example is meant to show how decisions like this could be analyzed. Everyone's financial situation is different, so decisions like this should always be evaluated based on your own personal circumstances. If you're interested in seeing how your situation on a home upgrade could work out in a stress test, feel free to use the stress test tool that I created on my own, and you could actually put all of your numbers in there and see for yourself. If you made it this far, thanks for watching, and I'll see you next time. Bye.